Hey, what's up? Welcome to DGen Ed. That's degenerative education, meaning none of this is financial advice. Just me having fun looking at charts like the chart behind me, which is of AMC Entertainment, ticker symbol AMC. And so here I am recording this on Saturday, November 23rd, after AMC closed on Friday, November 22nd, at a price of $4.55, being up about 1.33% on the day, but pulling back 1 penny in the after hours. And so, yeah, I wanted to go over the chart because, I missed it yesterday. And, it's actually a busy week for me. It's my weekend that I'm working. So I'm not going to have time to edit this. So I do apologize about that. But I did want to go over some things that, have been really helpful for me in positions like AMC that I've been holding for a long time. And, especially when price action gets pretty boring. And, because I think it's been pretty boring, especially when comparing with GameStop. That's been, going up a lot recently. AMC is still in this range between like $4 and $6. Not too exciting, especially being on that lower end between $4 and $5. But, over the past week, we did follow that uptrend that I talked about last Friday. It does look like we did kind of get a fake out break below. We got this little, it looks like a very nice dragonfly doji there. It would be nice if the open and close were just a little bit higher, so it'd be at the very top of the trading for that day on the 19th. But what you can see from there is the open was at 434, the close was at 434, big wick to the downside suggesting buyers stepping in, bottom is in, and then we got this pretty nice reversal green candle on the 20th going up 2.3% on the day and then reclaiming that uptrend. And as I've talked about in prior videos, is this level here at $2.24. We did not pull back and test that. We actually pulled back to a low on the 19th of $4.26. So I do think that is good. And I do think that it is good that we are putting in higher lows and moving up. But, talking about how this has been pretty boring trading, very slowly going up this uptrend and, being in this range here for quite some time, it's gotten me thinking about, as I've discussed previously, that there's this gap to the downside at 291, which I think that we may break below $4 a share and move towards this level, but I don't think that we will fill it because I think that those who are waiting for it to be filled will be left behind as the price then takes off to fill this gap at 685 and then continues higher. And so, what I've been thinking about lately has been the possibility of this just continuing to be kind of boring, whether it's, around 450 a week from now, or maybe it goes up to 5 or 6. If it's still in this, range that we've seen, it's still kind of boring. So, I have been thinking about different scenarios that might happen with the price action. I've also been thinking about covered calls. So I'll go over those in a minute, but I just kind of wanted to go over the possibility of a scenario because the sentiment that I've gotten following and during this earnings call, I did hold a stream and I was able to chat with some of you guys, is that morale's kind of down. It might be just the season change. It might just be how long we've been in this play. But I could see that a lot of us are pretty tired. We're fatigued of holding this. And so I feel like I just kind of wanted to go over the possibility of what could be happening and how covered calls might make holding AMC a little bit more interesting as it has been useful for me. But anyways, let's see. I'm going to take a step back. I might switch over to the weekly time frame to talk about this. And so I think I talked about this during the earnings stream that I held. I think I've probably talked about this during a Ticker Request Live on Sunday. But yeah, I just wanted to go over kind of my thesis with it being, actually, I probably need to step in for it like this. Again, sorry, I'm not going to edit this out. I just got to get to bed before early work tomorrow. But yeah, I'm just going to draw what I think could be happening. I might have to do this in a couple stages. So let's see. The drawing tool, I feel like there's a possibility we could break below 4, and then this could serve as like a spring, not getting to fill that gap. It is at 291 because we're going to leave people behind. And then with that spring, we then go up to fill this gap. And with that, maybe we consolidate here a little bit, bounce around there, form a bull flag. And then that's when those people who are waiting for that lower gap, they look at this and see, oh, that's actually a bull flag. We're going to get left behind. And then it really takes off from there. So it's my little bull flag after that gets smoothed out. And so I will continue that drawing in a second. I just want to make it a thick line so we know that, it's just for fun. And I'll make that green if price is to be going up. So, it dips down, dip buying opportunity, goes up, consolidates around that gap before these people FOMO in and push it higher. And then from there, we had this level here, 1143, which I had marked previously based on this high. This is the weekly time frame that I'm looking at. We had a high on the week ending November 10th of 2023 of $11.43 before we broke down, coming down over the course of that week, over 25%. And that level, that red line, would have been a great trimming level here. And so the reason why I point that out is not because I think we should have plans to sell or do anything in any way, shape, or form that we do not like, because I know a lot of people really just want to hold and never trim or anything like that. I think trimming is really nice. I had this level identified. I personally did not trim here. I thought it was going to keep going and stuff, but then we got rejected. It would have been good to trim there to buy back in this range, but it is what it is. So anyways, moving forward, if we do something like this, I think it's good to have a plan. And so the plan for if this were to get back up to around $7, consolidate around that gap before continue higher, I think it's good to have a plan for where this might be going. And so there's this other gap here. You can't see it on the weekly, but there is a gap over here on the daily at 1960. And so what I could see happening is potentially this continues higher and goes up to 1960 or 20, but then gets rejected. Maybe it's a sharp move down, like where the disbelief is marked. We get a very sharp move down, and then we start to see it consolidate above 1143 or above 12. And so, that's kind of what I think might be happening. I could be wrong. I'm sure I'm wrong. But, I think it's good to be thinking about these levels like $3, like $2.91. Are we respecting that? Are we bouncing? If we are bouncing, then, even getting back into this range where there are all these lines, that would still effectively be a dip buying level. If it is to move higher and consolidate above this level and then continue higher, getting rejected at 20, maybe 20 is the new 12, or the new 1143. Maybe 1960 is that new level. Maybe it doesn't get up to 1960. Maybe it only gets up to 19. Maybe that's a good level to trim a little before it pulls back and consolidates. And then, if let's say there are two people, there's one person that's holding 100 shares, just to have an even number out there. And they hold those 100 shares. They don't sell, they don't buy. And so what are they holding here? They're just holding 100 shares. So it's very like if you're an algorithm or you're a market maker and you're trying to manage all of these shares that are moving around. If your shares are just sitting here, those 100 shares are not doing anything. That's not going to be overwhelming for market makers. That's not going to be a catalyst for volatility because it's not volatile, it's controlled. Those shares are just sitting there. But if one sees this, looks at these technical levels, and says, yeah, well, let's say, I got 100 shares. I'm not going to trim my 100 shares up here because maybe it continues higher. but maybe I'd trim 50 shares. And if it pulls back to 1143, then I'd buy back those, basically 50 shares, but at a 50% discount or near 50% discount. So then maybe I could buy 100 shares rather than 50 shares. And then I'd be sitting here, same amount of money invested, but I'd have 150 shares rather than just 100. And the exchange of shares, I think, can really overwhelm those trying to make the markets and whatnot. So, I feel like that's kind of a nice idea, but, it also could, just continue higher up to the gap here, even on the weekly time frame, getting up to, let's see, the close there was at 46.41. So that's quite the possibility as well. But, looking at this on the daily time frame, just wanted to show you the gap over here at 1960. So there is clearly a gap there. So yeah, I just kind of wanted to throw that out. And then, I also wanted to talk about covered calls. Since it's been years, whether it's AMC or other positions that I've been holding, I've gotten fatigued in holding them. And I found that a nice way to make a little bit of money as things go down or as things are boring is by selling covered calls. And so covered calls can be pretty risky because, let's say that, I have a position in AMC. Just to be clear, I have two positions in AMC, one in Robinhood, which I don't really like that much. My average is around $8 a share there. And then I got another position in my Webull account, and that's around $10 a share. So I'm just going to kind of use those numbers as examples here. And so let's say there are calls. Let's look over at the options table here. So for this coming Friday, the 29th, let's say we've got these calls here. You can see up here. And the bid, so this is how much you would get to sell. So how much I would get to sell a covered call. If I have 100 shares, I could sell a covered call and collect premium here, which is under the bid, which here it says sell. I would then collect that premium. And so this premium is 8 cents, which is 8 cents times 100 shares. That's $8. It's not a lot of money, but it's something. And I would then have to sell my 100 shares at a price, at the strike price of $5 a share if AMC closed this Friday above $5 a share. And so since my averages are $8 and $10, that's not really appealing to me, especially with price so close to $5 a share. That is risky because I've been in situations with AMC, with GameStop, with other positions that I've held where I've had to sell at a strike lower than my average, and I was not happy about it. I've had it with a pretty small position with AMC. I've had it previously earlier this year with GameStop. Learned a pretty hard lesson there, and had to sell lower than I wanted to. But again, this is all about learning, and so feel like it's important to share that. And so, anyways, I think that's kind of the risk with covered calls. Is it's good to pick strikes that if there was to be a volatility event, and this was to go a lot higher, I need to pick a strike that I'd be comfortable selling my shares at. And so, like I said, I've got two positions, one that's about an average of 8, one that's about an average of 10. And so the maximum strike for this coming Friday, the 29th, is $8.50. And so for my one account, my Robinhood account, that's above my average. So do I want to sell those shares at $8.50? No. But would it be the end of the world if I trimmed, sold a portion of my position at $8.50? No, that wouldn't be the end of the world. I collect a premium of $2, and if it closes above $8.50, I'd have to sell those 100 shares above my average, make a little bit of profit. That's not the end of the world. That's not a huge deal. But there are some other risks to this as well. And so that is, let's say I'm set on, I'm just a little too exposed. I need to trim my position at $8.50. And so, I might as well just sell a covered call. And so let's say during the week, let's say on Wednesday, price hits 8.50. I could sell my shares, but oh wait, I sold this covered call, so I'm just going to wait for Friday's expiration, see what the closing price is on Friday. And let's say the closing price is at $4. It plummets back down. I'd be locked into those shares, and I would only get them back once the price closes on Friday on the 29th below 8.50. Then I get those shares back. But if the share price is $4, then it's like, well, I missed out. I could have sold them at 8.50, but I didn't do that. So I think it's good to think about that. I think it's good to manage that with covered calls because it can kind of lock you into a position that you might want some liquidity. But also, covered calls do take the emotion out of selling shares, which I know it's really tough to do. And I'm not suggesting that anybody does it. I just think that this could potentially be a nice way to pick up a little bit of premium. 2 cents here, which translates to $2. It's not a lot, but if you got hundreds of shares, that can add up. And so anyways, that is applicable for, my Robinhood account where my average is $8 a share. But it's not applicable for my Webull account where my average is $10 a share. So I was curious. I was looking at this last week. Well, when are the next contracts that have strikes above $10 a share? So this is for November 29th. The highest strike is $8.50. The most amount of money that I could get at or above my average in my Robinhood account is $2. Really not too exciting. So let's now look over to the following week. So this is December 6th. So that's the following Friday. We can see, hey, the strike went up a little bit to $9. That's a little more appealing because, that's applicable for the Robinhood account, not the Webull one, but applicable for the Robinhood account. And so we could see here that at the $8 strike, I could collect a premium of 5 cents, translates to $5 at that $8 strike. 850, kind of a weird number for some reason. That is, only 3 cents or $3. Not that appealing there. What's more appealing is the $9 strike. You get $4 back for that, but then those shares would kind of be, on loan effectively for 2 weeks. So, maybe that's of interest, maybe that's not. Again, I'm just going to continue down here to December 13th. Maximum strike is $8.50. So again, only useful for that Robinhood account with my average of $8 a share. But here, the premium gets a little bit higher, $7 per contract. But, it's like that those shares are locked away for not just 1 week or 2 weeks, 3 weeks. And so if, like looking back at this November contract for the 29th, $8.50, I get $2 for that. And so I kind of look at that as like, let's say I can make $2 every week. I could do that and then I'd end up with $6 over the course of these 3 weeks. Or I could just sell this one at one time and get that premium of $7. So I'd make an extra $1. So, maybe that's of interest. I don't know. And then finally, the next one that I'm going to go to is the monthly contract. Notice there's no W there. These are the weekly contracts. This December 20th, that is the monthly contract. Whoa, look at that. That's a little bit more exciting. The highest strike is $22. So, if my average is, let's say, $8 or $10, let's say my average is $15, I'd be all right trimming a little bit at 22 or at 20. I wouldn't want to get rid of all of my position because I think looking at the chart, there is potential for it to be getting up into the 40s. Maybe that takes a year, maybe that takes longer. I'm not saying it's going to get up there super fast, but if this is the long game, if we believe in this company and we want to be sticking around, I personally don't want to be getting rid of all of my shares at $20 a share, but I could certainly trim, especially if we move up to 20 and pull back and consolidate around 12. That makes sense to me. So I'd be all right with trimming at 20 and buying back at 12. And so here, what we can see is a $20 strike expiring December 20th. $5 premium. So it's really, not that exciting. Not to 5 cents, I should say, times 100 shares, $5 per contract. not really too exciting. But then we can go back down to these other ones here, and we can see that there is this $8 strike, so that'd be applicable for the Robinhood account where that average is around $8. I could trim at $8 and then I'd collect $11 from that premium, 11 cents times 100 shares. Or, again, 850, kind of an odd number. That goes down in value there to 9 cents, but the $9 strike, I could collect 10 cents premium there. So I think that's kind of nice. Moving up here, as these strikes go higher, the premium gets lower. As I had mentioned, the $20 strike, it's only 5 cents, translates to $5. But, I think this can be a nice way to make a little bit of money on the shares that I'm holding. And considering that I have hundreds of shares, I can sell multiple of these contracts, and I can do them at different strikes. So if, let's say, price does go up to $8 and close above $8 on December 20th, if I'm holding, or if I've sold this covered call, then, I'd have to get rid of those shares at 8. Even if it goes up to, let's say, $12 a share, I'd have to sell those shares at 8. So there's some risk there. If it goes up to $8 on December 13th, but then pulls back by the 20th, this expiration, then, if it pulls back down to 4, then I just was holding the shares and I didn't capitalize on them going up to $8 a share. I just held them and now it's back at 4. So that sucks, So there's risk with that. And so personally, what I like to do, by December 20th, I don't think that AMC is going to be up at $8 a share. But if it is, I personally would be all right to trim from that Robinhood account, not my Webull account. If it goes up to $10 a share, I personally would be all right with trimming in both accounts. And then moving up, and then if I have an average of $10 and I sell at 20, I'd be happy to 2x that dollar amount, especially if I think that $20 is a level that it might be getting rejected from before pulling back to 12. So I view this as kind of a nice way to take the emotions out and to kind of stage trim levels for if it were to close above these strikes on this date. If it gets up to $13 before this date and then goes back down, that's all right. I'm still holding the shares, and that's good. If, one wants to be holding, but if one wants to sell at 13 or one wants to sell at 20 and it closes on the 20th below those strikes, you're still stuck with those shares. You get them back once that expires out of the money. If it expires in the money, you gotta sell those shares at whatever that strike is. It doesn't matter what the price is on that day. If it's in the money, you're selling at that strike. So that is something to consider. But yeah, I just wanted to go over that if in case we see a big move up to $7 to fill this gap, maybe to 8. Maybe there's something nice to do with covered calls. And if it attempts to get up to 20, maybe it gets rejected. So maybe that's a nice level to either trim, to sell a little bit of a position. So, not all, maybe to sell all with the plan of buying back more. I think that if it goes up to 20, it seems, in my view, pretty likely that it will pull back maybe to 1143, maybe to 12, maybe to 15, maybe to 1660. I don't know. But I think if it goes up to 20 at some point in time, who knows when, I think it will likely be getting rejected there, just like we got rejected from right around 12, but we consolidated higher. And so I think that's just going to repeat. And with the monthly contracts expiring in December 20th, I think that could potentially be a nice way to make a little bit of money while holding the shares, and also to be staging levels to trim with the plan of buying back, or, if those who are holding this are in despair, are tired of holding it, maybe that's a nice way to make that despair a little bit lighter, to make it feel, less tiring to hold something that just hangs out in this boring range for such a long amount of time. So yeah, I mean, hopefully this is helpful. I'm sure a lot of people are going to disagree about this and think that this is a bad idea to sell covered calls. If you are, interested in buying calls, I did just put out an extensive options video that starts off with going over 3 AMC calls I'm bullish on. And yeah, I mean, I think that there are a lot of different ways to make money. And if something is just in this range, below $8 a share, I could have been selling covered calls every single week, at strikes above my average to make, a little bit of money on the side to then go back into AMC or something else. So yeah, I mean, hopefully that's helpful. If you guys want me to go over more stuff on covered calls, I'm happy to. But like, options are super risky, whether you're selling covered calls, whether you're buying calls, well, whether you're selling cash secured puts or buying puts. It's all very risky. I find selling cash secured puts to actually be a very interesting way to accumulate, go long on stocks, but I know that options can be pretty complicated. But it's something that I try to learn more about, I try to get better with, and so hopefully this video was helpful for you guys. And if you did find it helpful, make sure you like the video, share your thoughts in the comments down below, and make sure you subscribe to the channel for more videos like this. Thanks a lot for watching. Hopefully the thoughts of me and Ed were helpful. Take care, you guys.